So, what if you found an investment that was advertising a payout of nearly 40% a year? Your first thought would probably be, no way, that's got to be a typo or a scam, right? Well, today we're going to find out because we're putting a fund just like that under the microscope. Okay, let's just get right to it. Look at that number. Yeah, you are seeing that correctly. According to the data from Portfolios Lab, this fund's reported dividend yield over the last year was almost 40%. I mean, that is an absolutely insane figure. It's no wonder this thing is turning so many heads. And that leads us to the big question, doesn't it? Have we stumbled upon Wall Street's best-kept secret, some kind of hidden gem? Or is there a massive, glaring catch hidden somewhere in the fine print? Let's dig in and find out. So the fun in the hot seat today, and try saying this 3 times fast, is the Roundhill Innovation-100 DTE Covered Call Strategy ETF. Thankfully, for all of us, it trades under the much simpler ticker QDTE. It's a pretty new product from the folks at Roundhill Investments, and its entire purpose is to generate huge amounts of income week after week. Okay, so to figure out if this crazy yield is even remotely sustainable, we've got to pop the hood and see how this engine actually works. How on earth does it spit out that much cash? The first piece of the puzzle is right there in the name, zero-DTE. That stands for 0 days to expiration. We are talking about options contracts that literally live and die on the exact same day they're traded. The easiest way to think about it is like making a new bet every single morning on which way the market is going to move by the time the closing bell rings. It's extremely fast-paced stuff. The second piece here is the covered call strategy. Now, this is a classic move. In simple terms, you own something, let's say a stock, and you sell someone else the right to buy it from you at a higher price later on. For selling them that right, you get paid a fee, a premium, right now. That's your income. The trade-off is pretty obvious. You get cash in your pocket today, but you cap your potential gains if that stock suddenly skyrockets. Now here's where it gets really interesting. QDTE combines these two ideas in a very clever way. See, instead of actually buying all 100 stocks in the Nasdaq, it uses something called a synthetic strategy, or a poor man's covered call. It buys long-term options to get its exposure to the index, and then every single morning it sells those super short-term zero-DTE options against that position. The whole game is to collect that daily premium as income. All right, the strategy is a little complex, but it makes sense on paper. But as we all know, whenever you see a huge potential reward, there's usually a huge risk hiding nearby. So let's flip this thing over and start reading the fine print. Okay. We went digging through the fund's official prospectus, and yep, there it is. That unbelievable yield, well, it turns out it's not exactly what it seems to be. There is one massive catch here that pretty much changes the entire story. It all comes down to these 3 words, return of capital. The fund's own documents state that a significant portion of those weekly payments might just be your own money back. This means it's not profit. It's not a dividend. It's the fund literally handing you back a piece of your original investment. It feels like income, but it's really more like getting a rebate from your own wallet, which of course means your actual stake in the fund is shrinking over time. And the second major risk? It's that classic covered call trade-off, but on steroids. The prospectus gives a perfect example. Say the Nasdaq 100 has a monster day and rallies 2%. Well, because of QDT's daily strategy, its gain for that day is capped at only about 1%. So you get that little bit of income, sure, but you miss out on half of a huge market rally. Do that over and over, and you are leaving a ton of money on the table. And believe me, the prospectus is packed with other warnings. Because it's using those zero-DTE options, it's super sensitive to sudden market swings. There's liquidity risk, meaning it could be hard to sell at a good price. Those high payouts can lead to NAV erosion, which is just a fancy way of saying the share price itself can decay. And of course, it's totally concentrated in the tech sector. This is not some diversified, sleep-well-at-night fund. So all the theory and the scary warnings are one thing, but how has this fund actually done in the real world? Let's look at the numbers. And this, right here, is what that volatility risk looks like when it hits. The data shows that in its short history, the fund has already had a massive drop of nearly 23%. It took 60 trading days, that's about 3 months, just to get back to where it started. And it's had other big drops of over 10% too. This is not a smooth ride, folks. But hey, to be fair, it's not all bad news. When you look at the total return, and that's the key, you have to add back those distributions, the fund has actually been pretty competitive this year. It's even squeaked past the S&P 500. So this proves that in the right market conditions, the strategy can work. But that performance comes at a price. The fund charges a 0.95% expense ratio every year. That is way higher than a basic index fund, and it's a guaranteed drag on your money, year in and year out, whether the fund has a good year or a bad one. Okay, we've looked at how it works, we've dug into the hidden risks, and we've seen the real-world performance. It's time to put it all together and issue our final verdict. So after all of that, when you weigh the massive income potential against the very real risks of capital decay and missing out on big rallies, where do you land? Is this thing a buy, a sell, or a hold? Our final verdict on QDTE is a hold. But, and this is a really big but, this comes with some very important warnings. Let's be crystal clear. This ETF is not for everyone. In fact, it's not for most people. You should only consider holding this if you're an aggressive investor, someone who is laser-focused on income and who completely understands and can stomach the high volatility and the fact that your initial investment might shrink. If you're a beginner, a long-term growth investor, or just want a stable investment, you should avoid this completely. So here is the single most important thing to remember. In a bad market downturn, you could get hit with a brutal double whammy. Not only would the fund's share price likely fall, but the income stream, the whole reason you bought it, would probably dry up as well. You could be losing on both fronts at the exact same time. You know, I think a user on Reddit summed this up absolutely perfectly. They wrote, "The income is mostly going to be good while times are good." And that's exactly it. QDT is a tool that's built for a specific environment, and it's a high-stakes bet that those good times are going to continue. So the only question left is that a bet you're willing to make? That's all for this explainer. If you want more deep dives that cut through the marketing hype to get to what really matters, make sure you're subscribed. We'll see you next time.